Good. Well, good afternoon, everybody. Thanks for coming. My name is Albert Lehrhus. I have my own name tag, so you know who I am. I'm on the foundation board, and there are a number of foundation board members here today. Judy Cheney is back here, who really is very much involved in this. Frank Greif is always here, and so Frank is over here, and Mary Branham is down towards the front. I don't have a lot to say except to introduce these two gentlemen who are from an organization called Heritage Wealth Advisors, connected to Ameriprise. And so that I'm telling the truth here, I and my wife have been involved with this organization for years and have been extremely satisfied with the services provided to us. And this organization also holds money that the foundation has and invests it for the foundation, so they have that connection also. I'm going to introduce these two gentlemen. As they're talking today, if you have questions, I think they're happy to answer questions as they come to your mind. Just raise your hand. What I've found over the years is if I go to a seminar or presentation and I have a question and I don't ask it, I forget it. And when they get to the time where it's question and answer time, I go, well, it's in there somewhere, but I don't know where it is. So I'm in favor of asking and answering questions when they hit us. So these gentlemen, is Tanveer is here. He's going to speak, and Sean is back here. So the floor is theirs. The next time we're going to meet and have segment 2 of this is going to be July 13th, about the same time. You'll get plenty of publicity on this, and we'll see you then. And again, thanks for coming today.
Thanks, Albert. You guys can hear me all right? Okay, great. Well, thanks for joining us today. I'm Tanveer. Albert, thanks for the introduction. Here with my colleague, Sean. So we're with Heritage Wealth Advisors. We're based out of Mercer Island. And one of the things our team focuses on is how do we give the most confidence to the families that we work with, so that way they can have a bigger impact on what they're doing in their community, what they're doing for their family, the causes and organizations that they support. So we're going to do a 3-part series. Like Albert said, we're going to be presenting today. We're going to go over some basics today. We'll cover the agenda here in a minute. Then again, we'll be back in about a month. And then in August, we'll have a session with one of the estate planning firms that we work with. Tax reduction, estate planning, plan giving. This is one of the ways that we see clients get the most benefit of working with us. This is where our financial planning and tax teams will look ahead, and it's probably a little bit depressing when you take a look at lifetime taxes. It's going to be one of our largest expenses, more than food, more than housing, more than travel, more than medical expenses. And what we do is we look at ways that how could you go reduce that tax? How could you go shift it away from either the state or federal government? And how could you go support either your family, charities, different organizations that you believe in and support? The tax code is now 70,000 pages long, so it's overly complex, and it gets a little bit longer every time there's a revision or an amendment. So we just want to try to make it as simple as possible. I've been a financial advisor now for 14 years. I started right out of college. I've been with the Heritage team for 7 of those years. The last 7, I've served on the leadership team for 5 of those 7 years. Now I spend most of my time working with clients, focusing on income strategies and tax reduction. And then on the personal side, I've been married to my wife now for coming up on 8 years. We've got a little 2-year-old. And so we thought life was full without a kid, and now life is unbelievably full with a 2-year-old. And then Sean.
Am I good? Okay. So I work as a financial planning specialist and an associate advisor in conjunction with Tanveer. So I've been with Heritage for close to 4 years. I think July will be 4 years. I support the team in a bunch of different ways. One, we get to meet with clients, great clients like Albert. I also help build some of the financial planning models that we build for our clients and use with our clients. So some of the retirement cash flow analysis, tax planning, estate planning, some of the things that we'll share today. So my background is, building those tools. But we'd love to meet with clients like Albert. We're looking forward to the discussion today.
All right, so, and then like Albert said, if you have questions, just raise your hand and we'll try to address them as we're going through. So today we're gonna cover some estate planning, what we call 1.0, some of the basics. And then we're gonna get into some of the more advanced strategies. We've got a few case studies for you guys to look at today. And then here in about a month, we'll get into some more estate planning 2.0. That'll be once you've taken care of some of the basics, then what else can you go do to go reduce taxes? And we'll share more examples of gifting strategies our clients have used. And then in August, we're going to be with our estate planning firm. So the team member that we work with will share what are some specific things that you should plan for in the state of Washington. So the most important question in estate planning is who gets what. So history is full of examples of people with lots of money and then they have no named beneficiaries. So this is what I would call 101. And then it never fails to amaze when you think of otherwise successful and savvy individuals have used poor judgment in naming their beneficiaries. So you can see a few. You got Prince had a $300 million estate, all the way to Howard Hughes at a $3.8 billion estate, and there were no beneficiaries for either of those estates. Sometimes we think maybe it's just not acknowledging our own mortality. However, not having a will means that the distribution of your assets is going to be subject to whatever state you are domiciled in at your passing. And there's a chance that these laws will accomplish what you want, but there's a pretty high probability that they won't do it exactly the way you want it, and they probably won't do it in the most cost-effective way. So at its basic level, what is an estate? And to put it simply, it is everything that you own minus everything that you owe. So retirement accounts, 401ks, IRAs, Roth IRAs, 403bs, bank accounts, so checking accounts, CDs, savings accounts, any sort of personal property, jewelry, cars, stocks, so stocks, bonds, mutual funds, ETFs, any investment, life insurance policies, and then real estate. This adds up to what your total estate is, and Sean will go through just some basic estate planning.
Yeah, so estate planning is about caring for the people we love, what happens to what we've built during our lifetime, providing direction given a health issue, for example. Planning helps reduce taxes and costs, but it's also about passing on your legacy and values. Not just your assets. There's a reason for the common phrase, wealth rarely survives 3 generations. You take the Vanderbilts as an example. At one time, the wealthiest family in the United States, whose fortune was ultimately lost and spent and mismanaged across generations. So the difference isn't how well they invested their money. It's the fact that there weren't proactive steps taken to reduce costs, taxes, and most importantly, prepare the next generation for success. So really, estate planning is about moving from just building wealth during your lifetime to making a meaningful impact for future generations. So that's the why. The next step would be how. At a starting point, basic level, every plan would include a will, healthcare directive, power of attorney. These documents make sure that both your medical and financial decisions are handled by someone you trust if needed. If you don't have a will, the state distributes your assets based on their rules. For example, in Washington, your spouse may receive some of your assets, your kids may receive some of your assets, but it may not be distributed as you would wish. A living trust could be another step. We'll touch on some examples, but living trust would help you avoid probate, keep things private. Ultimately, the key point is making sure your plan and not the state's gets executed. So we say every dollar you have will go to one of 3 places: your family, the government, or charity and organizations. Most people default to a government-friendly plan where they gift to their family and the state and government impose a tax on everything else. What most people aren't aware of is how much of your wealth goes to the government is completely up to you. Today we'll cover some of the strategies you can use to disinherit the federal and state government and redirect money to your family, charity, and organizations you support.
Has anyone heard this Carnegie quote before? 3 generations from shirt sleeves to shirt sleeves? Okay, well, this will be a first for everyone then. So what does it mean? And this means even in the 1800s, and it's throughout history, if we go as far back as we can, we've seen a very concerning dynamic, which is sudden wealth is typically not a good thing for its recipients. The first generation creates the wealth. The second generation will typically maintain or manage that wealth. By the third generation, it's gone. So Sean shared the example of the Vanderbilt family. In today's dollars, their net worth was over $200 billion at the end of the 1800s. And then third generation, there's not a single millionaire left from that family. So what is sudden wealth? And think of that as anything that wasn't worked for. So a common ones of sudden wealth are a lottery, someone wins a huge lottery, or if they get an inheritance. So something that they didn't work for that was passed down to them from most likely a family member. Most of the families that we work with, they end up wanting to make some type of impact on their community or different causes that they've been involved with during their lifetime. And they're typically pretty concerned about if we give sudden or large amounts of wealth to our kids or grandkids, will it impact their behavior? Will they be less motivated because they have a large nest egg? Will they be maybe less ambitious because they don't need to work or they don't need to create income? And so what would happen if they didn't have that money as a crutch? So in one study, we found that 70% of families fail to transfer wealth from one generation to the next. And then we did another study that said only 5% of that failure was because of a failed estate plan or a failed financial plan. So it's not a financial reason that the wealth failed. It's typically because the family dynamics, they lacked a shared vision, they didn't have great communication, the heirs were unprepared to receive that level of wealth. So one of the solutions is family governance, which involves putting systems in place, putting practices in place, maybe even some traditions, and then ensure that those traditions and we'll call it systems practices, those are followed by future generations. So Sean just covered basic estate planning, why you should have a will in place, a trust, a medical directive, and this, we'll coin that estate planning 1.0, the basics. And this is estate planning 2.0. And if you're looking at this visual, there's a lot on here. We're not going to go through each one of these things. It's super complicated, but it's a visual just to highlight how complex estate planning 2.0 can be. So why the heck would someone go through all this trouble to say, should I do any one of those strategies there? And the purpose is A, it's to reduce taxes. B, it's to pass on values to the next generation. And then the third piece is to be able to give to causes that you've supported over the course of your lifetime, or maybe you didn't get to support as much and you want to with your assets. So like I said, tax code is complicated, over 70,000 pages. However, there are tons and tons of opportunities within the tax code to go redirect what otherwise would go to the federal government or to the state of Washington.
Yeah, and so this slide gives some tangible examples. You'll see individuals with a similar estate, yet some lose over 60% to taxes. So John Rockefeller lost over 60%, while others lose significantly less or relatively nothing. So again, Henry Kaiser, an entrepreneur from the 20th century, paid 2% of the total value of his estate in taxes. The difference between these individuals is what steps they took during their lifetime to reduce the amount of their assets that were subject to taxes. So estate taxes aren't just about how much you have, they're about what you do with it before you pass. And while these examples are for larger estates, the principle remains the same for an estate in the range of 1 to 5 million. A common misconception is that estate planning only matters for ultra-wealthy families. A big part of that is largely driven by focusing on just the federal estate tax. And although it's true the federal limit applies at higher levels, that's just one of many costs triggered at death. So there's state estate tax, income taxes, capital gains, legal and administrative costs, among many others. That's why estate planning isn't about just avoiding one tax. It's about minimizing the total cost of transferring assets. So Washington has been in the news for some changes, recent changes made to legislation. For the next 20 days, Washington is the worst place to die with regards to estate taxes. So we'll go through some examples here, put some context to these figures, but combined federal and Washington estate taxes can significantly reduce what families receive. So at the federal level, estate taxes can be as high as 40%. And then if we look at Washington, most recently, 20% being the highest tax rate, that could add up to over 50% of your estate. Another consideration is, given the U.S. budget deficit, every year lawmakers discuss how to increase tax revenue. And one of those things that's always on the table is how much to tax a person's estate. To give an example of how volatile this legislation can be, in 2015, the federal exemption for an individual was $5 million. Last year was $14 million, and currently it's $15 million. During the Biden administration, they considered reducing the exemption back to the $5 to $8 million range. And again, we share those examples just to illustrate what's in place today could change tomorrow.
Has anyone read about the Washington estate changes over the last year? It's kind of been a ping pong that Sean will take us through and kind of highlights the volatility of making a plan based on what the state has in place today might work today, but it may not, and there's a high probability that it could change.
Yeah, so a few figures that are specific to Washington. Prior to June of last year, Washington State gave a $2.2 million exemption per person, and the highest marginal tax rate was 20%. And then they retroactively increased the exemption, which is a good thing. Less of an estate was subject to taxes, but the top marginal rate increased to 35%, meaning this legislation would affect individuals who had already passed. So a couple of examples. A $20 million estate would pay over $1.4 million in additional taxes. A $30 million estate would pay just less than $3. A $50 million estate would pay almost $6 million in additional taxes due to this legislation. Again, hopefully these examples illustrate how complicated it can be, and more importantly, how quickly things can change. So Tanveer will jump into some case studies and examples of how our clients are maximizing how much they give to their families, charities, and organizations that they care about.
Yeah. Is, by show of hands, who's aware of the exemption and what that means in the state of Washington? So the exemption, I'll clarify for everyone, is how much of your estate will not be taxed by the state of Washington. So let's say you were a single person and your net worth was $3 million. The current exemption is $3 million, meaning if that was the size of your estate at your passing, the state of Washington would not tax you at all. However, if your estate was $4 million, they would say, okay, you have an excess of $1 million that's going to be taxed. That starts at a progressive tax rate at 10%. However, as it goes up, more and more becomes taxable. So just like our federal estate tax that's progressive, the Washington estate tax is also progressive. It starts at 10% and goes all the way up to 20%. Now, the other thing to note in Washington, if you're married, you get your exemption plus your spouse's exemption. There's a few steps that have to be taken to utilize that. So a married couple now has a $6 million exemption. So the entirety of that, or up to $6 million of their estate is going to be exempt from any sort of state taxes. Now, as soon as they go over that and they want to gift it within their family, that will be subject to taxes. What we'll start talking about now is we'll shift to, let's take examples of when you know you're going to be taxed by the state or the federal government. What can you go do to just shift that either to your family, to friends, to charities, to organizations, because almost every charitable organization that's classified by the IRS, you can get a tax deduction and a tax benefit for gifting. So we'll start with the donor advised fund. This might be one that you guys are familiar with, or many of you have heard before. A donor advised fund is it's a charitable investment account. You can contribute cash, you can contribute stocks, you can contribute bonds, you can contribute any sort of investment, and you will get an immediate tax deduction the day you make that contribution. They allow you to avoid capital gains. So go through an example. Maybe someone worked at Microsoft and they started at Microsoft in the 80s. They got some Microsoft shares at a very, very low price, low cost basis. And then Microsoft since then has done 500x. If that person were to sell their Microsoft, they would have to pay a pretty sizable capital gains tax. There's also a capital gains tax in the state of Washington and federally, depending on how much you sell. So if you sold it, or if you made a contribution to a donor advised fund, you would not have to pay any of those taxes. They all get wiped out. It's tax-free. Then on top of that, if you make a contribution, you will also get a tax deduction in the year that you make that. So you've eliminated two forms of tax that you would have otherwise had to pay. From the donor advised fund, you can make gifts as you please. So you could put a certain amount of money in there today, but you could choose to say, I want to gift that over 5 years, 10 years, 20 years, 30 years, to whatever organizations you want. So think of it as like I said, a charitable account that you get a tax deduction for. One concept here, so the second bullet point allows you a bunch of deductions in year one that you make that. So is anyone familiar with the standard deduction you get on your tax return right now? It's now north of $16,000 per person. If you're over 65, you get an additional deduction. If you're over 65 and under a certain amount of income, you get a third deduction. So it can be as high as, it's north of $20,000 now per person if you maximize it. So if you think of a married couple getting a $40,000 deduction, if you wanted to get a taxable benefit to gift, you would have to gift a lot of money. You'd have to gift over $40,000 a year for you to get a taxable benefit. A donor advised fund, one of the concepts that you can do is called bunching deductions, where instead of, let's say someone gifted $10,000 a year to different charities or organizations, instead of gifting $10,000 this year, they decide, I'm going to go do 10 years of gifting at once. So they make a $100,000 contribution to a donor advised fund. Now they're going to get a sizable tax deduction that year. However, they could choose to gift $10,000 as they please over the course of their lifetime. There's no limit to when you need to distribute those funds by. You also get a tax deduction. So up to 60% of your gross income can be deducted by a gift. If you don't use it all in year one, you have 5 years to use it. So in most cases, you can use 100% of the deduction that's granted to you. Another way you could gift is you could gift stock, or you could gift cash. So let's say I wanted to make a donation to the Hearthstone Foundation today. There's a couple different ways I could do it. One, I could gift cash. Let's say I owned a bunch of Microsoft shares and I said, I want to make a donation. I could go and I could sell $50,000 worth of stock. If I did that, I'd have to pay taxes on it. That'd be federally, it'd be about $7,100 of tax. Then I would gift the foundation $42,860. For that gift this year, I would get an income tax deduction of $15,800. So foundation wins, foundation gets money, and I get a benefit because I've reduced my income taxes. However, I could, instead of selling it, I could just gift the Microsoft shares directly to the Hearthstone. If I were to do that, I do not realize any sort of taxes. I could just take Microsoft's shares that I own, transfer them to the foundation, so there's no capital gains or Medicare taxes. The foundation receives $50,000, and I will get a larger tax deduction. So the Hearthstone wins, or any organization wins, along with the person who's making that donation. Another way of gifting is, has anyone heard of qualified charitable distributions? Few hands, few nods. So this is another way of gifting that has some very meaningful tax savings. So this is where you gift from a pre-tax retirement account. So think of a traditional IRA, a 401k, a 403b. Required minimum distributions are mandated at 73. Some people are at 75. However, if you are over 70 and a half now, you can gift directly from your pre-tax retirement account. So is everyone familiar with a required minimum distribution? You got to take it from your retirement accounts every year. IRS mandates it. They have a predetermined percentage, and then the better your retirement account performs, the larger amount you have to take out each year. So what you could do is up to the limits each year. So if someone had a $50,000 minimum distribution for 2026, they could gift up to that amount, if not more, and that would, one, satisfy their required minimum distribution, and then B, they don't have to pay any taxes on it. So if someone was going to gift $50,000 in a year, they could gift it directly from their IRA, and they don't ever have to pay taxes on it, and they satisfy their distribution. And of course, the organization that you gift it to, they don't have to pay any taxes on it either. And then we talked about this earlier. So this is bunching deductions. Again, the standard deduction's over $32,000 now. So one of the things we've seen is the clients that we work with will go over their gifting strategy over their lifetime. And depending on how much they plan to gift, we may choose to give them some guidance to say, let's go accelerate it. Maybe you gift 30 years of gifting, and you compress it down to maybe 5 or 6 years. And then if you do that in years that you have otherwise higher income, it can offset some of the taxes that you might have on other parts of your financial plan. Another strategy is gifting upstream or downstream. So if we think about your return, you have a tax return each year, but then go beyond that and think of how many tax returns do you have in your family. So you may have kids, you may have grandkids, and you may have parents, you may have grandparents. Use everyone's tax return in the family to say who may end up paying a more favorable tax rate. So an example, is it better for, let's say, is it better for you to sell some stock and then gift money to your kids or grandkids? Or if your kids and grandkids are in a lower tax bracket, does it make sense to gift stock to them and have them sell it under their tax return? One of the reasons a lot of people like gifting during their lifetime as well, you get to see the impact, whether it's kids, grandkids, or an organization, gifting with a warm hand. And then most kids, most grandkids, are more likely to benefit financially in their 20s, 30s, 40s than they might be in their 50s, 60s, and 70s. The other piece is there are limits to how much you can gift. And one of the common misconceptions is this annual limit, this $19,000. A lot of folks come to us and say, well, if I gift more than $19,000, do I have to pay taxes on it? The answer to that is no, you do not have to pay taxes on it in 99% of cases, unless you have already gifted your lifetime limit. So unless someone has already gifted $15 million in their lifetime, and if they chose to gift, let's say, $20,000 instead of $19,000, they're not going to pay any taxes on it. The thing that gifting over $19,000 does trigger is you got to file a form each year when you do your taxes. And so use the example, I gift $20,000 to someone. That additional $1,000 counts toward my $15 million lifetime limit. So if I'm never going to hit that $15 million limit, most people are not, you can gift as much as you want. You just got to have your accountant file an extra form. The other benefit to gifting during your lifetime is if I were to gift $19,000 a year every year to to people within my family, is my estate going to be larger or smaller at the end of my life? It'll be smaller. So if my estate is smaller, there's a lower probability that I'm paying taxes at a state or federal level at that time as well. Any questions on just this concept or strategy? Albert?
I have a question. Let's say I had money in a bank account. Let's say I had money in my bank account. And let's say I wanted to donate $5,000 to a charity. But I also have money in my IRA, and I've got to distribute part of that. Now, as I understand it, I could write a check from my bank account for $5,000, or I could make a qualified charitable distribution from my IRA.
That's correct.
Which one should I do, and why is one better than the other?
Yep, so the question is, if Albert was going to make a $5,000 distribution or contribution to a charity, should he write a check from his bank account, or should he do it from his retirement account? So long as you're over 70 and a half, 9 out of 10 times, and 99 out of 100, it makes more sense to do it from the retirement account, because that's income that you would have had to pay tax on, but now because you do the qualified charitable distribution, no taxes are owed, and that $5,000 is still sitting in your account. You can do whatever you want with that. Great question, Albert. Yep.
On the last slide, it said a bunch 5 years of gifts together. What's that referring to?
Yeah, so thanks. The question was bunching 5 years of gifts. What does that mean? So you could elect to gift and bunch 5 years of deductions at once. So take your $19,000, do it over 5 years, but you do that all in 1 year. If you do that, you would not have to file any sort of separate form. You just say, hey, I'm gifting 5 years at once. Great question. And the other piece too, to clarify, this $19,000 is per person, recipient, I should say, per recipient. So if I were to gift, I could gift everyone in here $19,000 and I wouldn't have to file anything on my return. The moment I cross $19,000 per person, or for any person, that's when I would have to file an additional form. Yes?
Do they have to file any return based on the gift they received?
Yeah, great question. So the question is, does the recipient have to file any forms when they receive an inherit or a gift? Typically, the answer is no. Federally, you do not have to. However, certain states may have an inheritance tax. Washington does not have one. So here, you wouldn't have to file anything. Yes?
Be mindful of financial aid and opposite.
Yeah, great question. So if someone were applying for financial aid, that looks at your income. It also looks at the total assets. So let's say a grandparent had a net worth of a few $1 million and their grandchild had a net worth of maybe a few $1,000s, and their parents had a net worth where they would qualify for financial aid. All of a sudden, grandparent makes a large gift to either grandchild or kid. Now they may not get the same sort of financial aid because their net worth is higher. Yeah, great question. Many other questions before we jump from this slide? Okay. Who's familiar with capital gains tax? Yeah, so capital gains tax has been in the news in Washington. So typically, capital gains is a preferred form of taxation because it's lower than ordinary income. So if Sean made $100,000 in W-2 income, he's going to be paying about a 22% tax rate. If I made $100,000 in capital gains, I'd be paying about 15%. It'd be much more favorable for me. Most people would rather pay 15 versus 22. And that's true of all capital gains income versus ordinary income. Washington introduced some extra taxes, and it was targeted at maybe some specific residents of the state, but also people who were receiving large amounts of stock from companies like Amazon, Microsoft, T-Mobile, Starbucks, Costco. And the rule, I think it came into effect a couple years back, said if you realized more than $250,000 of capital gains, you had to pay an extra tax. So everything above and beyond 250, you had to pay another 7%. Then they went and they introduced another level of tax last year that said if you realized over 1.2 million of capital gain, then you had to pay almost 10%, 9.9%. A capital gains bypass trust is a strategy that anyone can use to go reduce their capital gains down to zero. So there's a number of different types of trusts. So this helps you avoid paying tax whenever you sell an appreciated stock. So let's say someone had, we'll use Microsoft as an example. If they had a bunch of shares of Microsoft that were now worth millions of dollars, but they bought them for maybe tens of thousands of dollars, they'd have to pay tax on that difference. If they sold it in a capital gains bypass trust, they would not have to pay any tax. The tax would be zero. So they could potentially be avoiding a tax at 33%, which would be pretty costly. So there's a few ways to avoid it. We're not going to go through all of these, but a few of the types of trusts are charitable remainder trusts, pooled income funds, flip unitrusts, NIMCRUTs, and legacy income trusts. We won't bore you with all the details, but we'll go through a few of them. Yes? These are federal. So let's start with a charitable remainder trust. So you put the money in the trust and then you can sell assets and reinvest the gross proceeds versus the net proceeds. And then you can live off the income produced. You get a significant tax deduction for the contribution that you make. And then whatever amount is projected to be remaining, so the remainder part of it, that would end up going to charities and organizations that you would designate as your beneficiary. So let's say Ben and Jen, they've got $2 million of Microsoft stock and they paid $500,000. So that's their cost basis or their principal. If they were to sell it, if they said, hey, which happens pretty commonly, right? You accumulate the stock, then you have to sell it to go live off of, you'd have to pay taxes on it. So let's just say they sold it all in 1 year. So the year that they sold it, they would have to pay $300,000 of tax on that $1.5 million gain. Then they would be subject to a Medicare tax. That's an additional 3.8% for $57,000. And their net proceeds after that would be $1.64 million. So they receive the $1.64 million. They can do whatever they want with that. And then assuming a 4% dividend rate, let's say they invested into something conservative, they'd be receiving $65,000 of income every year until that money runs out. They wouldn't get a tax deduction. There was no benefit to anyone other than Ben and Jen, and they wouldn't get a tax savings. They were paying one of the highest tax rates. And this is only federal. This is not including the state estate tax. So let's say Ben and Jen did not want to do an IRS-friendly plan. They wanted to gift some of this money over their lifetime. They would instead move this stock into a charitable remainder trust, and they would sell it there. Now immediately, once they sell it in the trust, there is zero taxes owed federally or in the state. So just off the top, they've saved themselves $357,000 of tax. Now they get to invest $2 million versus $1.6 million, and the income that is produced by a trust can be anywhere from 5 to 10% of the total amount. So let's assume 5%. They now create an income stream of $100,000 for the rest of their lives. Because they made a large contribution to a trust, you can't undo this. Once it's in the trust, you can't say, hey, I changed my mind, I need that money back. Once it's in there, you can draw an income, but you can't undo the initial move. In the year that they do this, they would have a tax deduction of $722,000. So they would get a massive financial benefit for making this contribution. And then over time, they would save over $600,000 that they would have had to pay in taxes on that income as well. They live off this income for, let's say, 30 years. Whatever remains at the end, let's say there's $1 million left in this account at the last passing of Ben and Jen, that $1 million would go to whatever charities or organizations that they had designated as their beneficiaries. Cannot go to family, though. Has to go to a qualified charity or nonprofit organization. Any questions on charitable remainder trusts? Okay, I'll share one more. This is another type of capital gains bypass trust. It's called the Legacy Income Trust. And these are in ways they're very similar to the vehicle that we just saw. You put money in, you get a tax deduction, and you get income during your lifetime. And then at the end of it, whatever's left goes to charities. The biggest difference with this vehicle is that it doesn't just pay you or your spouse, it could actually pay 8 other people. So you could have this go, if you had a grandchild that was 10, you could say, I don't want to give them a large lump sum of money. However, I do want them to have a stream of income for the rest of their life. This could pay up to 10 beneficiaries. At the last passing of the 10th beneficiary, whatever is remaining would go to charity. So this is a way that folks will set up a stream of income to pay their family versus if someone were to get $1 million or $2 million or a large lump sum of money and they could spend it at their discretion, it may not last as long. That's some of the impact of sudden wealth. And then here's an example of a legacy income trust. Let's say a couple in their 50s, they're married, no kids, they take $10 million of stock and they put it in the legacy income trust. The actuaries would expect a 39-year life expectancy. They would receive $24.5 million of income during their lifetime. Then their average income is going to be about $628,000 a year. That's down here. So they would receive $628,000 of income each year, which would be taxed at capital gains. And if you were taxed at ordinary income, you'd be paying 37. In this case, they're paying about 24. If they were to do this type of strategy without a legacy income trust, they would net $450,000 a year. They'd have to pay taxes on that income. After all taxes were paid, they're probably receiving anywhere in the $260,000, $270,000 range. The other two things I'll point out. Sorry, go ahead.
Does it have to be capital gains? Could you use these trusts for any other money you have?
You can use these trusts for all after-tax accounts and savings that you have. So anything that is a non-retirement account. So stocks, bonds, real estate, just not a retirement account for this specific vehicle. So the so what here is they make a $10 million deposit. They receive income for the rest of their lives. They would also get a tax deduction in the year of the contribution of $4.6 million, which would yield about a $1.7 million tax savings over their lifetime. So we'll close out. We appreciate you guys all taking some time going over this. I know there's a lot of numbers, there's a lot of percentages, there's ordinary income, there's capital gains. It's confusing, it's complex, and I think that's the way the IRS made it with a $70,000 tax code. Know that we're a resource for you. If you guys have questions, let us know. We'll hang out for a little bit. And then if you grab the form at the front, if you guys ever want to have just a conversation that's specific to you, feel free to call us. We're here. We'll give you some generic guidance. And if it makes sense to do a tax projection, we can do that for you. We could share what you'd pay in taxes. Again, that's not the most fun thing to do. But once you're equipped with that, you could decide, hey, is there something I want to do to go reduce what I'm going to pay in taxes? Any questions as we close out? Albert?
just have a couple of comments here. One is thank you to Tanveer and Sean for coming here. I really appreciate their coming, giving them their time to provide information to us. And frankly, I appreciate the turnout. Thank you for coming. The foundation is working very hard to provide information to residents of the Hearthstone, and showing up really makes us feel good about this. I've heard this information before, and I think you can't hear it too many times. You really can't. Every time you hear this type of estate planning information, you pick up a little bit more, a question is raised in your mind, and it's an ever-changing landscape. I hope to see all of you on July 13th, which is going to be part 2 of all this. And if you've benefited from this, bring your friends, tell people about this, and we'll have a bigger turnout on the 13th. There's a handout that you're going to receive before you leave here. Take it, take a look at it, fill it out, opportunity to ask more questions. So, a question?
Are you brokers or advisors?
We're advisors.
I've got nothing to sell. Nothing to sell. Pardon me?
Who is the broker?
Meaning, like, are we going to give you generic guidance or product guidance?
No, I'm not talking advice. I'm saying, who do you give the instruction to do the buying and selling?
Oh, okay. We do it with Ameriprise.
Any other questions? I'm trying to speak as loudly as I can, Teresa. So, no, listen, I appreciate that. I appreciate your comments that when people talk from a crowd, they don't tend to speak up, and so not too many people get the benefit of the question. So I appreciate your remark on that. So thank you very much. Get the handout. Oh, Mary.
Yeah, I have a question about the last thing that you talked about, the legacy income trust. That doesn't involve any charity that you are contributing to. It's spread out, though. You said you could up to 10 different individuals.
That's right.
So that's so that would be a big difference from the charitable remainder trust.
It functions the same as a charitable remainder trust, meaning the remaining part at the end of the last beneficiary's life would go to charities.
Oh, so there is a charity.
There is a charity,
that
correct.
Incorporate in that whole process.
Correct. The difference between the two is the legacy income trust, the time when the charity receives the funds could potentially be way down the road. Yeah, I'll repeat. So the question was, what is the difference between the legacy income trust? Is there a charity that receives the funds at any point when compared to the charitable remainder trust? Both of them are charitable remainder trusts. And the remainder portion means whatever is left at the end of your lifetime would go to the charities that you designated, charities or organizations. However, with a charitable remainder trust, it can only be one or two people, a couple. It could be a single person or a married couple that are the beneficiaries of the income during their lifetime. After that, it goes to charities. With a legacy income trust, there can be up to 10 individual income beneficiaries. So instead of it just being you or you and your spouse, you could have kids, you could have grandkids, and the income is going to pay for a lot more years. At the end of the last person's life, anything remaining would go to charities that have been designated. Great question. Yes?
Some of these trusts will go on for quite a while. So do they usually have professional trustees as opposed to your uncle or your cousin?
Yeah, great question. So the question is, some of these trusts can go on for many years. Is there any professional, we'll call it professional management of the trust? Who figures out how to invest it? Who figures out how much income gets distributed? What goes to organizations? The answer is yes. So there are certain trusts which we'll call plug and play. The Legacy Income Trust, for example, this company has all of the professional resources. They figure out how to invest it, they figure out the income, they do the paperwork, they just send their recipients a K-1 at the end of the year to file their taxes. A charitable remainder trust may require, it'll definitely require a lawyer to set it up initially, and then it typically requires a CPA every year to do a filing to say what was the value of it and how much income will the beneficiaries get. So there's typically a cost, usually in the few $1,000s a year, for just the maintenance of the trust. Any other questions, or have we given you enough numbers and details for the day?
Awesome. Yeah, thanks everyone.
Thank you guys.